Hi, I'm Erik Ogard, CIO of the Wealth Plan Group. We're in the middle of earnings season. It's currently late April, and companies are reporting their earnings results for the first quarter. We're about halfway through earnings season, and the report is, so far, things are coming in very reasonably well. Most companies are in line or beating expectations, about consistent with historical averages, maybe a little bit better, and that's a very good thing. That's why, after a brief pullback in early April, stocks are now beginning to show an ability to have some resilience in price, and we think that's because the earnings are coming through okay. We do note that if a company misses earnings or guides lower into the future, the market has been treating those companies very harshly with pretty dramatic drops right off the bat. And the reason for that is that stocks are expensive. If you look at the cyclically adjusted price earnings ratio, or CAPE ratio, popularized by Robert Shiller of Yale, the CAPE ratio is now the third highest it's been in its history, going all the way back to the 1880s. It was only higher prior to the spike in 1999 in tech stocks, and then again just before the 2022 correction back. But we're back at levels in the CAPE that suggest some caution is in order. I've called this price for perfection, and so when stocks are trading at these very elevated levels, it means that it's got to go perfectly well, and if it doesn't, you're getting multiple contraction because they're priced so high. So if you're having holdings deliver earnings okay but guide lower, and then you see your stock price decline dramatically, that's because stocks are priced for perfection. Now, there can be a tendency for people to want to just bail out of those stocks and go into the ones that haven't been treated that way. And if we're in some sort of a rolling price to earnings correction where we're revaluing stocks, one of the worst things you can do is just bail out of something and go into something that hasn't been mistreated. The odds are pretty likely that as this cycle progresses, every company is going to take a PE haircut when they're priced for perfection. So you may just end up selling something that got harshly treated this time, going into something new that is then about to get treated harshly. And so we think in markets like this, it's very important to have reflective time where you're not reflexively just selling something because the guidance is lower. It's really important when stocks are expensive like this to know what you own and to know why you own it. If those things change, if the reason you own something changes, you were wrong on the fundamentals, or you were wrong on the business model, the strength of the business model, something surprised you that told you had misunderstood, probably a good reason to sell, but not just because the market is taking multiples in. Be very thoughtful and circumspective about selling in those conditions. If you are an investor that's paying attention to the equity markets, there's a great deal of what could be considered FOMO right now, or fear of missing out. If you're looking at the S&P 500 index in particular, this is being driven by what we call a very narrow market. It used to be the Mag 7, and now we're down to about 5 stocks driving indexes higher. And just a way to think about this is if you compare the S&P 500 index to the S&P 500 equal weighted index. The only difference between those two indexes is one is weighted, the individual securities are weighted by the market cap or the size of the company. Bigger companies carry a bigger weight, and we're in the most concentrated market cap of the index in history. We're sort of like looking at over 30% of the index's weight is in the top 10 stocks. So we've got a very concentrated index. And it happens that those mega caps have been performing so much better than the rest of the market. If you think about what has this equally weighted index done, by the way, same 500 stocks, equally weighted just means you own the stocks in the same increment. So 500 stocks in an index would be 20 basis points, or 1/5 of 1% in each name. Whereas in these cap weighted indexes, you'll end up with, 8 to 10% in the biggest stocks. So huge differential in that cap weighting. So over the last 3 years, the S&P 500 has produced a return that is 3 times the magnitude of the return to the S&P 500 equal weighted. You're talking about 27% on average annualized over 3 years versus 9. Now, that 27% is so outside of bounds, it's so unusual that if you have this FOMO and you chase after that index, you could end up really regretting it. And so we come back to know what you own and why you own it. And if you're achieving your long-term goals as an investor, irrespective of maybe not liking missing out on those great companies that are now dominating, you're still good. Chasing them right now, like if you go back to the 1999 episode of Market Concentration and Mega Cap Dominance, people that capitulated late and chased that ended up paying a very, very dear price. So know what you own, why you own it, and don't capitulate. That's very important. I wanted to kind of highlight a couple of things, and FactSet does some marvelous work and they've got some really great charts. During the first quarter, the mega cap, I'll call them the Meg 5, Amazon, Google, Meta, Microsoft, and Nvidia, those 5 stocks are producing 64% year-over-year earnings growth. The rest of the market is facing an earnings decline of about 6%. This is why we have such a bifurcated market. The early beneficiaries of the AI era, let's call it, are these mega cap companies, and they are really taking advantage. The question is, will the technology of AI lead to productivity enhancement that will trickle into a second wave and a third wave of companies? And we think the answer is yes. And that's certainly where Wall Street expectations are. If you transition to what's expected not just in the first quarter in terms of earnings growth, but the remainder of 2024, we see that those mega cap 5 are expected to grow 34% year over year in quarter 2, whereas the other 495 are expected to grow 6.2%. Fast forward to the third quarter, those companies, the mega caps, are expected to grow 17.6. The other 495 are expected to grow 7.3. And then finally in the fourth quarter, the mega cap 5 are expected to produce about 19% earnings growth year over year. And the great news is expectations are that the other 495 are going to produce 17.3% year over year earnings growth. So that's a catching up. And that would be a reason to have confidence that these markets will broaden, and to not chase the dominant mega cap 5 right now. Like, the cost of that could be just enormous. In the midst of all of this, again, if a company guides forward in a way that's pessimistic or leading expectations downward, the market is treating those companies harshly. There may be nothing wrong with their fundamentals, but again, when you're priced for perfection, go back to that CAPE ratio, makes it very hard for companies to hold stock value when there's some kind of a negative announcement or forecast. So, stepping away from all of this, as we walk through the remainder of the quarter's earnings, we think it's kind of going to go like it has. So we expect this to be a solid earnings season. We'll see what the guidance is. We'll pay attention to the macro factors that may be causing earnings to be better or worse than expected. And we'll step through it day by day. And if you do have these instances where you're having FOMO, again, go back to what you own and why you own it. If you're meeting your long-term objectives, if you've got the right risk loads, have patience. Do not capitulate. That's usually the worst thing an investor can do. So until next week, thank you for your time and appreciate your interest. As always, if you have questions or need a deep dive on your portfolio, we have a roster of very talented advisors across the country that would love to have that conversation with you. Thanks so much. See you next time.